Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's just get right into it. If you've ever placed a trade, you know the real battle isn't with the flashing numbers on the screen. Not at all. It's with those two little monsters that live inside your head, greed and fear. They are the reason most traders fail. But what if I told you there's a way to put those monsters in a cage? A way to trade with total clarity? Well, today, we're going to break down exactly how to do that. You know, this quote from Jesse Livermore, who is just one of the greatest speculators in history, it absolutely nails the core truth of the market. He said this almost 100 years ago, and it is just as true today. Think about it. Technology changes, companies come and go, but human emotion, that's the one thing that never changes. Those patterns you see on a chart, they're not random. They are the literal footprints of our collective hopes and fears. And that really brings us to the million-dollar question, doesn't it? If the market is just this giant arena of human psychology, how in the world do you come out on top? Well, the answer isn't about being smarter than everyone else or finding some secret algorithm. No, it's about building a fortress against your own emotional impulses. So let's start by actually mapping out this emotional maze. You see, the reason so many traders fail isn't because they're not smart. It's because they lack a structure in a world that feels like total, absolute chaos. You know, you really have two competing ideas about the market. On one side, you've got the random walk theory, which basically says it's all just unpredictable noise. But folks like John Person and legends like Livermore, they're firmly in the second camp. History repeats itself. And why does it repeat? Well, because people repeat themselves. And if you can learn to recognize those recurring patterns, you, my friend, have an edge. And this chart, wow. This is what happens when you substitute hope for an actual plan. This is Lucent Technologies. At one point, this company was the next big thing. Investors just held on, hoping for a comeback. But the market, well, the market had other plans. Hope is one of those four emotions Livermore mentioned, and believe me, it can be the most dangerous one of all. So, if emotion is the enemy, what's the solution? It's not about turning into a robot. It's about giving yourself a clear, repeatable system, a set of rules that can guide you right through all that emotional noise. This is the secret weapon of consistently profitable traders. A rule-based approach means you're not guessing anymore. You're not hoping. You're not trading based on a gut feeling. Instead, you have definitive, recognizable patterns, things like candlestick formations that you can see on a chart, and you have established rules for your entry, your exit, and your risk on every single trade. It's all about consistency over instinct. Look, with all the indicators, the news alerts, the so-called experts shouting on TV, it's incredibly easy to get overwhelmed by data. But John Person argues that in this massive ocean of information, there's really only one piece of data you need to focus on to get your bearings. That's it, the closing price. Not the crazy swings that happen during the day, not the morning hype. The close is the final verdict. It's the price where the market finally settled and agreed on the value for that day or that hour or that minute. It is the single most important piece of information on any chart you look at, period. So if you've got your rules to follow, the very next step is to build a professional framework around them. This is where you make a huge shift in your mindset. See, the most successful traders on the planet, they don't see the market as a casino. They see it as a business they operate day in and day out. And here we are, back to the master himself. Jesse Livermore's entire career, with all of its incredible highs and devastating lows, can really be boiled down to just three core ideas. These are the absolute pillars of any trading business. Okay, so this is the magic trio. First, timing. You can be totally right about where a stock is going, but if your timing is off, you're still going to lose money. Second, risk management. This is your survival skill. It's all about protecting your capital so you can live to trade another day. And third, the big one, emotional control. This is the ability to actually stick to your plan when greed and fear are screaming in your ear. So here's how you actually put that into practice. You create a business plan. You track your expenses, like data feeds or software. Most importantly, you decide exactly how much you are willing to lose on a trade before you ever click the buy button. You diversify. And above all else, you always follow the plan that you created when you were calm and rational, not the one your emotions are trying to invent in the heat of the moment. Okay, so you've got the mindset, you've got the business plan. Now it's time to choose your tools and your battlefield, because not all markets are created equal, and not every strategy is going to work in every situation. You really do have a whole arsenal to pick from. You can trade traditional stocks, leveraged futures, diversified ETFs, or even the 24-hour Forex market. But here's the key. The core principles of having a rule-based plan apply to every single one of them. Each of these battlefields has its own personality, sure, but the real enemy, your own emotion, is always the same. And always remember, just picking a stock doesn't mean you're going to have a happy ending. On the left, there's Apple, one of the greatest comeback stories ever. On the right, Lucent, a story of just complete collapse. Both of these companies were once darlings of their industry. This right here is why even a buy and hold strategy still needs rules for when it's time to get out. Now, let's look at something a little more advanced. Instead of just betting that a stock will go up, what if you could bet that one company will do better than another? Think of it like a horse race. You're not just betting on a horse to win, you're betting on it to beat one specific rival. This is called spread trading, and it's a powerful way to isolate the strongest player in any sector. This is a perfect example. Apple and Dell, both in the same industry. By going long Apple and short Dell, you're not just betting that Apple will go up, you're betting that it will be stronger than Dell. And as you can clearly see from these charts, that would have been a phenomenal trade. You isolated the leader from the laggard. And that brings us to the final, and honestly, the most important battleground. You can have the best rules, the best plan, the best tools in the world, but none of it matters without one absolutely crucial ingredient. And here it is, straight from the man himself. True confidence doesn't come from trying to predict the future. It comes from having a system that you trust and having the patience to wait for your signal, your specific trigger, before you make a move. You see, anticipation, that's emotion. Waiting for confirmation, that is discipline. So after all this, we come to a simple truth. The market isn't your enemy. It's just a reflection of the crowd. The real challenge, the final boss in this entire game, is you. It's winning that inner game. And that really is the ultimate takeaway, isn't it? A good system, like the one we've talked about today, it gives you the rules of engagement. It gives you a map and a compass. But a map is totally useless if you refuse to follow it. So the question I'm going to leave you with is this. The system provides the rules. Can you provide the discipline? You know, for most people, the stock market feels like this giant, sprawling casino. It's all about making wild bets, getting lucky, and hoping for the best. But for the pros, it's something else entirely. It's a structured business. So today, we're going to crack open their playbook and show you exactly how they turn what looks like chance into a calculated operation. So let's just tackle the elephant in the room. Is trading really just a fancier, high-stakes version of gambling? It's a fair question. And honestly, it's a fear that keeps a lot of people away. For many, it even becomes a costly reality. But here's the thing. The difference between a gambler and a pro isn't the stocks they pick. It's the mindset they bring to the game. Let's really break down these two mindsets, because they are worlds apart. Over here, you've got the gambler. They're running on pure, raw emotion, right? There's the greed for that one big score, the fear of missing out, that desperate hope a losing trade will magically turn around, and, well, ignorance of a real plan. But then you look at the pro. They've replaced all that emotional chaos with a logical system. Greed gets replaced by rules. Fear, that's replaced by discipline. Hope becomes patience. And ignorance gets swapped out for a rock-solid strategy. And that brings us to the biggest hurdle in trading. And it's probably not what you think. See, it's not really about outsmarting the market. It's about mastering yourself. The real fight, the one that matters, is against our own human nature, our own built-in emotional knee-jerk reactions. You know, the legendary trader Jesse Livermore said this almost 100 years ago, and it is just as true today as it was then. Human nature doesn't really change. The same cocktail of greed, fear, and hope that moved markets back then is what moves them right now. And that is where the pros find their edge. They understand that human emotion is both the single biggest risk and the single biggest opportunity. Now, you'll hear all these academic theories, right, that the market is a random walk or that it's perfectly efficient, which basically means you can't beat it. But pros, they work off a totally different assumption. They believe history repeats itself for one simple reason. Human beings are predictably emotional. Their entire edge comes from spotting the patterns created by the collective greed and fear of the crowd. Okay, So, how do we make that jump? How do we go from being driven by our gut feelings to acting with that cool, professional discipline? Well, for the answer, let's go back to the wisdom of a legend, Jesse Livermore. Livermore basically boiled down his entire incredible career into 3 key ideas. Number 1, timing, knowing when to get in. Number 2, risk management, knowing how much you're willing to lose and when it's time to get out. And number 3, the most important of all, emotional control. That's the discipline to actually stick to the first 2 rules no matter what your gut is screaming at you. If you get even one of these wrong, the whole thing just falls apart. This right here, this is a fundamental mind shift. The pros accept right from the start that they cannot predict the future. Their job isn't to be a fortune teller. Their job is to be a disciplined manager of capital. They focus on reacting to what the market is doing right now, not what they hope it's going to do tomorrow. So all of this, it all builds up to what is probably the most powerful analogy for anyone who's serious about trading. If you want professional results, you absolutely have to start treating your trading like a business. Think of yourself as the CEO of your own company, you Incorporated. And as the CEO, you've got some serious responsibilities. You need a formal business plan. That's your trading strategy. You have to track your expenses, everything from data feeds to your computer. You have to commit to always be learning. You have to ask the tough, critical questions before every single business decision, before every trade. But your number 1 job above all else is to protect the company's capital. Because without that, you're out of business. Simple as that. So I want you to ask yourself this question honestly before you even think about your next trade. Are your entry and exit points justified by your system, by your rules, or are they really just based on a feeling, on hope? The answer to that question is pretty much the difference between running a business and just placing a bet at the casino. Okay, so to run this business of yours successfully, you need the right toolkit. And I'm not talking about some fancy, expensive software. I'm talking about a simple toolkit of rules. Rules designed for one thing and one thing only, survival. Because in this business, staying in the game long enough to win is the ultimate prize. Want to see how fast things can go south without rules? Just look at this. Let's say you have a $10,000 account, and you decide to risk a pretty hefty 10% on each trade. It would only take 5, just 5, losing trades in a row to wipe out half of your capital. Let that sink in. In 5 bad moves, your business is on life support. That is exactly why risking too much is a one-way ticket to failure. And that leads us to the single most important truth in all of trading. Before you even dream about the profits you can make, you have to be obsessed with managing your risk. Protecting your downside isn't just a part of the game, it is the whole game. It's the only thing that keeps you in business long enough to catch those big winners. A huge tool in that risk management toolkit is diversification. The Nobel laureate Harry Markowitz put it perfectly. He said it's the closest thing to a free lunch you'll ever get in finance. And it's true. Spreading your capital out across different assets is a powerful way to cushion the blow if one of your ideas turns out to be a dud. Now, these principles, treating it like a business, managing risk, controlling emotions, they aren't just abstract ideas you read in a book. They directly impact the assets you choose and, more importantly, how you manage them. Just a passive buy and hope approach is not going to cut it in the long run. Let me show you why. Just take a look at these 2 charts. This is the danger of buy and hope in action. On the left, you've got Lucent Technologies. This was a market darling, a superstar stock that went to zero. Anyone just holding on and hoping lost everything. Now, on the right, you've got Apple. It also had a massive crash, but then it staged one of the greatest comebacks in history. The point is, you can't just close your eyes and hope. A pro has a plan that tells them when to hold on, but just as critically, when it's time to cut your losses and get out. And hey, it's not just about avoiding a total disaster. Look at Walmart here. This is one of the biggest, most successful companies on the planet. And for 7 straight years, the stock went absolutely nowhere. It just went sideways. If your capital was tied up in this, you made 0 returns for 7 years. That's called opportunity cost. And it's another huge reason why you have to be actively managing your positions. So how can a trader today put these ideas to work? Well, one of the most popular tools is the Exchange Traded Fund, or ETF. Basically, it lets you buy an entire basket of stocks, say the whole technology sector or all the energy companies, in a single trade. It's an amazing way to get that instant diversification we talked about. But you have to remember the lesson from Walmart and Lucent. Even with an ETF, you still need a plan. You still need rules for when to get in and when to get out. All right, let's bring it all home. Here's your final playbook. The key takeaways. Number 1, trade like a CEO running a business, not a gambler at a casino. 2, use a system of rules to take your emotions out of the equation. 3, always, and I mean always, manage your risk before you even think about the reward. 4, actively monitor your positions. Remember, hope is not a strategy. And finally, number 5, never ever stop learning. The market is constantly changing and you have to change with it. Look, the only thing that separates professional trading from gambling is a set of rules and the discipline to follow them. The playbook is open, the secrets are out. The real question is, are you ready to stop placing bets and start running a business? Most people look at market analysis and they see complex science, maybe even some kind of financial wizardry. But what if I told you it's a lot simpler than that? What if it's less about complicated formulas and more about learning a language the market is speaking all the time, right there in its charts? And in this explainer, we're going to learn the basic grammar. So let's just jump right in with a quote that probably goes against every single instinct you have about investing. Buying high is a technique that very successful professional traders use. I mean, it sounds completely backward, doesn't it? We're all taught buy low, sell high. That's the golden rule. I know what you're thinking. That makes zero sense. Our whole instinct is to find a bargain, to buy low and then sell high. So how could anyone, let alone professionals, succeed by deliberately buying high? It seems like a recipe for disaster. But this one single counterintuitive idea, well, it's the key to a really powerful trading philosophy. And that philosophy all starts with a fundamental shift in your mindset. It's about learning one simple rule: don't fight the market. See, successful trading isn't about trying to outsmart everyone. It's about learning to agree with the market and just follow its lead. So forget about the crystal ball. Seriously, the goal is not to guess where the market is going next week or next month. The real key is to see, with clarity, what it is doing right now, and then just align your actions with that reality. This is all about reacting, not predicting. This whole approach is built on the idea of momentum. Think of it like a high-stakes auction. What happens when the bidding gets fast and the price starts climbing? Well, it creates excitement, right? It draws in more bidders, and that just pushes the price even higher. Markets work pretty much the same way. A rising price attracts more buyers, which just adds more fuel to the fire. The idea is to join that auction while it's hot, not to try and guess what the final price will be. Okay, so to really understand this momentum, we need to learn the basic grammar of the charts. And the good news? It's actually incredibly simple. Any market, at any given time, can only be in one of 3 states. That's it. So what are they? A market is either going up, that's an uptrend, or it's going down, a downtrend, or it's just moving sideways, kind of stuck in a range. That is the entire universe of what a market can do. Your first job as a trader is just to figure out which of these 3 states we're in right now. And the definitions are surprisingly specific. An uptrend isn't just prices going up. Technically, it's a series of higher highs and higher lows. Each new peak is higher than the last one, and each little dip or pullback is also higher than the last one. And a downtrend, it's just the exact mirror image, a series of lower peaks and lower valleys. And here's what that looks like on some real charts. On the left, you've got IBM in a classic uptrend. See how every time the price dips, it finds support at a higher level than before? Now look at Dell on the right, which is in a downtrend. Every little rally just runs out of steam at a lower point. That's the market's language in action, telling you who's in control. Okay, so we know what to look for, but how do we see these patterns clearly when a chart can look so noisy and chaotic? Well, that's where a couple of really simple tools come in handy. The first tool is the good old trend line. It sounds technical, but I promise you it's not. For an uptrend, you just find the lowest point on the chart, draw a line connecting it to the next significant dip, and then just extend that line out into the future. That is literally all there is to it. Going back to that IBM chart, you can see exactly how this works. By drawing that one simple line, you've basically created a visual floor for the price. It helps you stay focused on the main trend and shows you a really clear area where buyers have been willing to step in. But what if a chart is just too jagged, too messy for a simple straight line? Well, our second tool, the moving average, can be your best friend. What it does is it calculates the average price over a certain time period. And by doing that, it irons out all the crazy highs and lows to show you the real underlying trend. And the rules for reading it are just as simple as the trend line. Is the price trading above the moving average line? Then the market is considered bullish or strong. Is it trading below the line? Well, then it's considered bearish or weak. It's a quick visual gut check on the market's health. You'll also notice something pretty cool. The moving average often acts like a center of gravity. When prices get stretched way too far above it or way too far below it, they tend to snap back, kind of like a rubber band. This is a famous phenomenon called regression to the mean, and it just shows how that average can act like a magnet for the price. So far, so good, right? But trends, well, they don't last forever. They pause, they get tired, and this is where our story gets a twist. And it's where a trader faces their most critical decision. After a really strong run, a market will often stop making those nice higher highs and just start moving sideways, back and forth in a range. We call this a congestion or consolidation phase. The upward momentum has stalled, and the big million-dollar question becomes, is this just a quick rest stop before the trend continues, or is this the beginning of the end? Now, in the best-case scenario, it's just a pause. Here is a classic example from Apple back in 2005. You see a strong uptrend, then a few months of going nowhere, and then bam, the uptrend resumes with incredible force. This is the exact pattern trend followers dream about. But, and you knew there was a but coming, right? The market doesn't always follow the script. Sometimes that sideways pause isn't a resting point at all. Sometimes it's the market gathering energy for a massive move in the complete opposite direction, a reversal. And a reversal can be absolutely dramatic. Just look at this chart of the euro. You see a clear uptrend, then that sideways consolidation, and then the floor completely gives out, a sudden, sharp reversal into a powerful new downtrend. This is both the danger and the opportunity that every trader has to face. So, if we can't know for sure whether a pause is going to lead to a continuation or a total reversal, what do we do? Well, it all comes back to that core philosophy we started with. Success isn't about having some magical ability to predict the future. It's about having a plan to react to whatever the future brings. It's about having the discipline to follow the clues the market is giving you and just go with the flow. So, to put it all together, your job is not to guess the exact top or the exact bottom. Your job is to use these simple tools to identify the market's current state, uptrend, downtrend, or sideways, and then to act without hesitation when the evidence shows you that state has changed. In the end, it's that simple, and it's also that difficult. The market is constantly giving you clues about its direction and its strength. It really is speaking its own language. Learning to read it is the first step. The real question is, once you understand what it's saying, are you prepared to have the discipline to actually listen? All right, let's talk about one of the toughest parts of trading, knowing when a market has just gone too far, too fast. You know that feeling, right? You're looking at a chart and you're just asking, is this the top or is this the bottom? Well, today we're going to break down how to spot those extremes so you can see them as real opportunities. I mean, that's the million-dollar question, isn't it? After a huge run-up or a massive nosedive, how do you actually pinpoint that moment where things are about to turn? The thing is, prices just can't keep going in one direction forever. They have to take a breath. And that's exactly where these ideas of overbought and oversold come into play. So, let's get our language right. When we say a market is overbought, it just means prices have jumped up so high, so fast, that a pullback is probably on the cards. And on the flip side, oversold means prices have dropped so hard that it might be due for a bounce. Simple, right? But understanding these two states is absolutely fundamental. Now, how do we measure them? We need the right tools. Okay, our first tool is a total classic, the stochastic oscillator. The best way to think about this is like a momentum gauge on your car's dashboard. It helps us see if the engine, the buying or the selling pressure, is starting to run out of gas. This indicator was developed by a guy named George C. Lane, and it's built on a really clever observation. He noticed that when a market is trending up, prices usually close near the top of their recent range, and when it's trending down, they close near the bottom. The stochastic oscillator just watches for when that pattern starts to break down, which is our clue that momentum might be about to flip. So the indicator has two lines that do all the work. You've got the %K line, which is the fast one. It reacts to price changes pretty much instantly. And then you have the %D line, which is just a smoothed out, slower version of the first one. Now the real magic, the signal we're looking for, happens when these two lines cross each other, especially when they're in extreme territory. So what counts as extreme? Well, the first zone to watch is anything above the 80 level. When you see the stochastic lines creeping up this high, it's a big warning sign. It's telling you, hey, this market might be overbought and this rally could be losing steam. And of course, on the other end of the scale, we have the area below 20. A reading down here is basically saying the market is oversold. The sellers might be getting tired and a potential bounce could be right around the corner. All right, let's see how this looks on an actual chart, because this is where the theory turns into a real strategy. Take a look at the indicator at the bottom. Over on the left, you can see the lines dip way down below 20, and then they cross back above it. That's your buy signal. Then later, on the right, they shoot up above 80 and then cross back below it. Bam! That's your sell signal. It's a perfect picture of how this works. So here is the key, the actual rule you can use, which the source material calls the hook signal. Don't just jump in because the indicator is above 80 or below 20. You have to wait. You wait for the lines to cross, and then you wait for them to move back out of that extreme zone. That final step, that's your confirmation. That's your trigger. Okay, on to our second tool. While stochastics is amazing in markets that are kind of choppy or range-bound, the MACD indicator, well, this one is your best friend when the market is really trending hard in one direction. MACD stands for Moving Average Convergence Divergence. It sounds complicated, but all it really does is look at the relationship between two different moving averages, a fast one and a slow one. And by watching how they move together and pull apart, we can get a really good read on the strength, direction, and momentum of a trend. Now, you'll usually see MACD with two lines and a histogram, but for what we're doing today, let's just focus on that histogram. You know, those little vertical bars? They literally just show you the distance between the fast and slow lines. If the bars are above the center 0 line, momentum is positive. If they're below it, momentum is negative. And that moment they cross that 0 line, that's a huge signal. Check this out on the chart. You can see the price is kind of messy, trying to figure out where the bottom is, but the MACD cuts through all that noise and gives us a really clear signal. See it right there? The histogram bars flip from being negative, below the line, to positive, above the line. That's our confirmation that the bulls are finally starting to wake up and take control. And this really gets to the heart of it. It's not about trying to perfectly guess the absolute bottom of a move. It's about being patient and waiting for a tool like MACD to come in and confirm that a real shift in momentum is happening. It just helps you filter out all the false signals. It's really that simple, but it's an incredibly powerful concept. Across above that 0 line helps confirm your right to be bullish. Across below it helps confirm a bearish view. It's just a fantastic way to add another layer of confidence to your trades. Okay, so we've covered the basics of stochastics and MACD. Now let's level up and get into a more advanced signal that you can spot with both of these tools. And trust me, this is where things get really, really interesting. We are talking about divergence. So what on earth is divergence? Well, it's when the price on your chart and your momentum indicator are telling you two completely different stories. Picture this. The price of something makes a brand new high, but at the same time, your momentum indicator makes a lower high. That is a huge red flag. It's the market basically whispering to you that the strength behind that new price high is fading and a reversal could be coming. And here are the two main types, side by side. Look at the left. That's bearish divergence. See how the price makes a higher high, but look down at the indicator. Its peak is lower. That is a classic warning sign that a market might be topping out. Now look at the right. This is the opposite, sometimes called bullish convergence. The price hits a lower low, but the indicator makes a higher low. That suggests the sellers are finally running out of steam. Now, here are some actual concrete rules for trading a bearish divergence using the stochastics. First, you need that initial peak to be up in overbought territory. Then, the market has to make a new, significantly higher price peak. But, and this is the crucial part, the indicator's second peak has to be lower than its first. And the final rule, maybe the most important one of all. Don't act until the price itself confirms the reversal by closing lower. You have to wait for that confirmation. So we've gone through overbought levels, we've looked at 0 line crosses, we've talked about divergence. As we start to wrap things up here, I want to focus on the single most important idea behind all of these tools. Please remember this. Stochastics, MACD, they are not crystal balls. They cannot predict the future. Their entire job is to measure what's happening right now with momentum and to confirm for you when a shift is actually happening. Think of them as your confirmation committee, not as fortune tellers. Getting that confirmation is absolutely key. It's incredibly valuable. But it does leave us with a pretty fascinating question to think about. What if you could learn to read pure price action so well that you could actually anticipate the turn before these indicators even give you the signal? Now that is the next level. Thanks so much for joining this explainer.
All right, today we're going to dig into something really cool. It's a classic tool, but it's one that can help you see when a big market trend might be about to turn on a dime. It's kind of like a way to see past all the noise and figure out what the market's really trying to do. So let's get into it.
I want you to think about this for a sec. We all stare at charts, right? We see prices moving up, prices moving down. But what if that price action, the thing everyone is obsessed with, isn't telling you the whole truth? What if it's actually hiding a huge weakness just beneath the surface?
Well, it absolutely can. There is a way to pull back the curtain and see the real strength, or more importantly, the lack of strength in a market move. And the secret isn't in the price itself. It's just a little bit lower on the screen. And that right there brings us to our secret weapon, volume. Now, this isn't some fancy, complicated new indicator. Nope. It's actually one of the oldest, most fundamental, and frankly, most reliable pieces of data we have. Yeah, you heard that right. We're talking for over a century. Way before computers were on every desk, traders have been using this one simple metric to get a read on the conviction behind a trend.
So what is volume, exactly? Well, it's pretty simple. It's just the number of shares that are bought and sold over a certain period of time. It's a direct measure of market participation. You can think of it like the size of a crowd at a concert. Is it a stadium packed with screaming fans, or is it just a few people kind of milling around? That's what volume tells you.
And this, right here, is the key takeaway. Volume is the best tool out there for confirming what the price is doing. See, if prices are climbing higher, you want to see that big, enthusiastic crowd, high volume, to back it up. If those two things don't line up, well, that's when you know something is off.
Okay, so let's put this into practice. Let's talk about the first big use case, how to use volume to spot a lie at the top of the market, that moment when a stock looks super strong but it's really just running on fumes.
The pattern we're hunting for is called a bearish divergence. This is a huge red flag. It's what happens when the price of a stock keeps grinding to new highs, but the volume, that market participation, is actually getting smaller and smaller. It's a classic signal that the rally is losing its steam.
Let's look at a real-world example. It makes it so much clearer. Here is Amazon from back in late 2005. If you just look at the price, everything looks great, right? It's in a clear uptrend, making higher highs, looks perfectly healthy.
But now look below the price. See those bars at the bottom? That's the volume. And notice how as the price is climbing, the volume is shrinking? That disagreement, that is the bearish divergence. The source material calls this a dead giveaway that the rally just couldn't last. And of course, they were right. The stock rolled over hard.
All right, you want an even juicier example? Let's talk about Apple, also from 2005. The story here was incredible. It was the holiday season, iPod sales were, quote, through the roof. Every piece of news was bullish, and the stock was just taking off like a rocket. And yet, look at the volume on that final surge. As the price screamed from $75 to over $85, the volume was just fading away. Fewer and fewer people wanted to jump on board at those high prices. The conviction just wasn't there. And when the turn finally came, it was just like the source said. It was like a boulder falling off a cliff.
Okay, so that's how you can spot a top when it's running out of gas. But what's really cool is that this works the other way around too. We can use the exact same logic to help us find market bottoms, to see when a nasty downtrend is finally exhausted. And the logic is just so simple and elegant. To spot a top, you're looking for prices going up, but volume going down. To spot a bottom, you're looking for prices going down, on volume that's also going down. In both scenarios, the message from the market is the same. This trend is losing its energy.
And this has a name too. We call it bullish convergence. It's when the price keeps making scary new lows, but fewer and fewer people are actually selling. It's a really powerful clue that the sellers are just getting tired. The selling pressure is drying up. Let's check out this case study of Starbucks from early 2005. Man, this chart looks pretty rough, right? The stock is just getting hammered, hitting lower and lower prices. It looks like the last thing you'd ever want to buy. But again, what do? We look below the price. And as Starbucks was making those frightening new lows, the volume was just disappearing. The sellers were running out of steam. I love how the source material puts it. It said this was a sign the market was percolating and getting ready to pop higher. And that's exactly what happened. So it's pretty clear that volume is incredibly powerful all on its own. But what happens when you start combining it with other classic technical tools? Well, that's when you can get the ultimate confirmation signal.
For our last example, we're going to look at a big one. Toll Brothers, the home builder. Back in 2005, this is right at the peak of the housing bubble. And it makes such a great point. People always say nobody saw it coming. But the truth is, the chart was practically screaming a warning. You just had to know how to read it.
Just look at this. It's like a perfect storm of warning signs. First, as Toll Brothers hit its final peak price, the volume was already declining. Check. That's our bearish divergence. At the exact same time, look at the MACD indicator below it. It was also making a lower high. And then the stochastics indicator, same thing, another bearish divergence. You had 3 different tools, all pointing to the exact same conclusion. This thing is done. So look, the big idea here isn't about memorizing chart patterns. It's really about developing a whole new way of looking at the market. It's about giving yourself the superpower of asking the right question at the right time.
And it really just boils down to this simple process. Step 1, what's the price doing? Is it going up or down? Step 2, what's the volume doing? Then, step 3, are they moving together? Are they in sync? If the answer is no, then you've got a divergence. And that is your cue for the most important step of all. You have to stop and ask yourself why. Because when the price and the volume are telling you 2 completely different stories, that's the market's way of whispering that something is wrong under the hood. It doesn't matter how great the news is, or if the fundamentals seem, as our source says, wildly bullish. That lack of participation is a giant warning sign that the trend is not as healthy as it looks. And that's really what this is all about. It gives you the power to ask these critical questions. If a stock is soaring and everybody's telling you it's a sure thing, you can look at the chart and ask, okay, but why aren't more people buying? And if a stock is in free fall and there's panic everywhere, you can look and ask, well, if it's really that bad, why has all the selling dried up? And asking those questions, that's how you really start to understand what the market is thinking.
Welcome to The Explainer. You know, when you look at a market chart, it can seem like pure chaos, right? Well, today we're pulling back the curtain on a secret weapon that professional traders use to find order in all that madness. It's all about seeing the invisible structure of the market.
So imagine this. What if you could know the key price levels where a market is likely to stall or maybe even reverse before the trading day even begins? That's the kind of predictive power we're going to get into today. See, the big institutions and the pros, they aren't just reacting to the market minute by minute. A lot of the time, they're working with these predetermined price levels. You can almost think of them as hidden lines on their charts, key spots that most everyday indicators just don't show you.
So what is this powerful tool? Well, it's a time-tested method called pivot point analysis. And really, it's just a way to forecast the potential trading range for the day based entirely on what happened the day before.
At its core, the main pivot point is a surprisingly simple calculation. It's basically like finding the financial center of gravity for a trading session. And this one single number, well, it becomes the heartbeat, the foundation for all the other levels we're about to build off of.
Now, this brings up a really crucial distinction. Most of the tools traders use, like moving averages, are lagging indicators. It's kind of like driving while only looking in the rearview mirror. They only tell you what's already happened. Pivot points are totally different. They are a leading indicator, giving you a look through the windshield at where the big battles between buyers and sellers are most likely to happen.
And this quote right here, it gets to the very heart of why this works. See, pivot points use the high, the low, and the close of a session. And those 3 data points, they perfectly capture market emotion, from the excitement at the high to the fear at the low. They're really just a mathematical snapshot of human psychology.
But, and this is important, the market is not a perfect machine. It's not always going to hit these levels with surgical precision.
Sometimes, yeah, the price will bounce perfectly off a line. Other times, it might dance around the level for a while before making its next big move. So we need a framework to understand these different reactions.
All right, so how do we actually create this roadmap? Let's get into the math. And don't worry, you don't need to be a math genius for this, just some basic arithmetic. It's surprisingly straightforward. First up, we have to establish our foundation, the primary pivot point, or P. It's just the average of the previous day's high, low, and close. This one line is our starting point for everything else. From that pivot, we project levels above it. These are our resistance levels, R1 and R2. Think of them like potential ceilings, where a rising price might just hit a wall of sellers and run out of steam. And then, of course, we calculate two key levels below the pivot. These are our support levels, S1 and S2. These act as potential floors where a falling price might find a bunch of buyers and bounce. So together, these 5 lines, P, R1, R2, S1, and S2, give us our basic roadmap for the trading session. Okay, but here's where it can get a little tricky. If you start digging around, you'll find there are even more levels you can calculate, R3, S3, all these midpoints, and pretty quickly, your nice, clean chart can turn into a total mess.
I mean, it's really easy to end up with 13 or more lines just cluttering up your screen. And that's not helpful at all. It's information overload. It leads straight to what they call analysis paralysis, where you're just so overwhelmed you can't make a clear decision.
So, the trick here is to simplify. We need a way to filter out all that noise and only focus on the levels that actually matter for what the market is doing right now. And the best way to do that? Just look at the overall trend. And here is that filter in action. It's pretty elegant, actually. On the left, if the market's in a downtrend, we're mostly watching for rallies to fail at that first resistance level, R1, with an ultimate target down at the second support, S2. On the right, in an uptrend, we just flip it. We look for pullbacks to find support at S1 before the price heads up toward R2. This simple filter just cleans everything up and focuses our attention on what's most likely to happen.
Now, once we've got that filter down, we can move on to what is honestly the most powerful technique the pros use. This idea of finding confluence. This is where pivot points go from being a pretty good tool to an absolutely incredible one.
Just remember this phrase, because it is the absolute key to understanding why confluence is such a big deal. It's all about multiple things pointing to the same exact conclusion.
So confluence happens when pivot levels from different time frames all line up in the same price zone. So for example, what do you think happens when the daily S1 support, the weekly S1 support, and the monthly pivot point all land in a super tight price range? You get a super level of support.
Just picture it. You've got day traders watching their daily pivots, getting ready to buy. At the exact same time, you've got swing traders looking at their weekly pivots, seeing a major support level. And then you have the big long-term institutions looking at their monthly pivots, and they see the same thing. Everybody is watching the same zone, all getting ready to act. That is the power of confluence.
And let's look at a real-world example here, because this is just awesome. On this weekly chart of Alcoa, you can see a confluence of the weekly S1 support at 22.33 and the monthly S1 support at 22.99. So where did the market bottom out? At 22.28, smack dab in the middle of that powerful confluence zone. It's just an amazing demonstration of how these levels can pinpoint major turning points.
So what's the big takeaway here? It's really about replacing emotional, gut reaction decisions with a calculated, logical roadmap. Pivot points give you clear, predetermined levels that help you manage your trades and avoid those common mistakes, like bailing on a good trade too early or holding on to a loser for way too long. It really does transform your view of the market, from something that seems chaotic and random into something with actual structure and logic. It gives you an edge. And that really leaves us with one final thought to consider. Now that you know how to find these hidden levels, how is that going to change the way you see the market?
If you're a trader, chances are you've used a moving average. I mean, it's one of the most common tools out there. But what if the standard way of using it is actually part of the problem? Part of the reason so many traders struggle. Today, we're going to look at a completely different way of thinking about averages, one that might just change how you see the entire market. Okay, let's just start with a pretty sobering number. It's estimated that around 70% of traders lose money. 70! That's a huge majority. So what's going on here? Is everyone just getting lucky, or is there something fundamentally broken about the way most people are taught to trade? And that really brings us to the core idea. This quote just hits the nail on the head. If you're doing exactly what everyone else is doing, using the same tools with the same settings, how on earth can you expect to get a different result? To beat the average, you've got to think outside the average.
And here's the problem in a nutshell. It's crowd mentality. Think about it. Most charting software has default settings, right? The 10, the 20, the 50-day moving averages. The financial news is always talking about the 200-day. So when a huge chunk of the market is all staring at the exact same line, reacting to the exact same signal, well, it creates these predictable and often losing patterns. It becomes a self-fulfilling prophecy where everyone gets whipsawed together.
So, if following the crowd is the problem, the solution is to step away from the crowd. We need to find a different kind of average, one that gets us closer to the market's true value.
All right, here is the key difference. A standard moving average, it only cares about one thing, the closing price. But think of all the action that happens during a trading session. The pivot point moving average is totally different. It takes into account the session's high, its low, and the close. It gives you what the source material calls the average true price for that entire period. It's a much more complete story.
And the engine behind this is actually super simple. You just take the session's high, add the low, add the close, and then divide the whole thing by 3. That's it. By doing this, you're not just looking at where the price ended up. You're finding the mean, the true center of gravity for the entire trading range.
So, a single number is great, but we need a line on our chart, right? So here's the crucial next step. We take that pivot point value we just calculated, and we apply a simple 3-period moving average to it. This just smooths out the raw data and creates a nice, clean line that the source author calls the market direction number. This is the indicator we're going to be watching.
Okay, enough theory. Let's see this thing in action. How do we actually use it to read the market's price flow?
And here we go. This chart illustrates its main job perfectly. Just look at how the price interacts with that line. In an uptrend, the price comes down, kind of kisses the line, and then bounces right off. It acts like a dynamic floor or support. And in a downtrend, it's the exact opposite. The line becomes a ceiling or resistance that keeps pushing the price back down. It's our reactive guide for the trend.
But it's not just about where the line is. It's about where it's going. The angle of the line, the slope, is a huge clue about the market's strength. A steeply rising slope, like you see here, is basically screaming that there's strong buying pressure under the surface. It's a clear, bullish bias. And if that line starts to flatten out, that's your early warning that momentum might be starting to fade.
Let's look at another one. See how this pivot average line almost perfectly hugs the lows of the candles all the way up? This is exactly what you want to see in a healthy trend. It doesn't just help you identify that you're in a trend, it gives you the confidence to stay with it because it's constantly confirming that the market is still moving in your direction.
Okay, so the single line is powerful stuff. But now, let's level up. We can make this even more precise by adding a second line and creating a crossover system.
This is called the Conditional Optimized Moving Average System, or COMAS for short, which, yeah, is a bit of a mouthful. But the idea behind it is actually really simple. We're just going to use the interaction between a faster moving average and a slower one to give us really clear signals for when to get in and out. This diagram shows the whole concept perfectly. The faster line, which is more sensitive to recent price changes, is the pivot point itself, and the slower line is our 3-period pivot point average. Now the magic happens at the crossover. When that faster line crosses up and over the slower line, that's our early warning signal that the market's internal momentum is shifting from bearish to bullish.
And here it is on a real daily chart. Just look at that crossover in late November. It gave a fantastic signal right before that huge run-up. The lines stayed apart, they pointed up, it was a beautiful trend. Then, just as important, look at the crossover back down in mid-December. That was your early warning that the party might be over right before the price dropped.
All right, so now that we've seen the concept and we've seen it in action, let's put it all together with some simple, actionable rules for trading this. Let's break down the entry triggers. For a long or a buy signal, you're waiting for a downtrend to fizzle out, and then you want to see the price close decisively above the moving average. For a short or a sell, it's the opposite. Wait for an uptrend to stall, then look for a close below the average. But, and this is super important, you need confirmation. For longs, you want to see the market start making higher highs and higher lows. That confirms the new trend is for real. And to figure out how healthy that trend is, keep these tips in mind. First, you want both moving average lines sloping in the same direction as your trade. That's a great sign.
You also want to see a nice clean separation between them, almost like they're moving in parallel. Now, if the faster line gets way too far away from the slower one, that can be a warning sign that the market is overextended and might be due for a pullback.
So we'll end with this question. By thinking differently about something as basic as how an average is calculated, by moving from just the close to the entire session's range, you're fundamentally changing your whole perspective. You're no longer just following the crowd, you're aiming to see the market's true center of gravity, its real underlying direction. And that, right there, might just be the edge you've been looking for. What if you could actually read a market's mind? You know, these strange-looking bars you see on charts? They're called candlestick charts, and they're not just data, they're a visual language. And today, we're going to teach you how to speak it. We'll show you the human story of fear and greed that's hiding behind every single price swing.
So here's the core idea you really need to get. These charts, they're not just a bunch of numbers. They are a direct picture of market emotion. Every single candle is like a little snapshot of the battle between greed, pushing prices up, and fear, driving them right back down. Understanding that, well, that's step one.
I mean, that's the big question, isn't it? When you look at a market chart and everything's moving like crazy, it just looks like total chaos. But what if you could actually decode that chaos? What if there was a hidden language to understand the psychology behind every tick up and every tick down? Well, there is. The key is learning the language of these candlestick charts. This isn't just some random pattern. It's a whole collection of individual stories. Each one of these candles is a snapshot of the fight between the buyers and the sellers over a specific period of time. Doesn't matter if it's a minute, an hour, or a whole day.
Okay, so let's learn the alphabet of this new language. We're going to break down just a single candle. Every candle you see, no matter its shape or color, is built from just 4 key pieces of information: the opening price, the closing price, the highest price, and the lowest price for that period. That's it.
All right, let's start with a dark or, a red candle. We call this a bearish candle. Now, the thick part, that's called the real body, and it shows you the range between where the price opened and where it closed. Those thin lines sticking out, those are shadows or wicks, and they show you the absolute highest and lowest points the price hit. A red candle just means one thing: the price closed lower than where it opened.
And on the flip side, we've got a white or green candle. This is what we call a bullish candle. All the parts are exactly the same. You've still got the real body and 2 shadows, but here the story's just flipped. A green candle tells us the price closed higher than where it started. Simple as that. The buyers were in control.
So, if you remember just one thing, let it be this. It all boils down to one simple rule that decides the candle's color. If the close is below the open, the sellers won that round, and the candle's red. If the close is above the open, the buyers won, and the candle's green. That's it. That's the foundation for everything else we're about to talk about. All right, now that we've got the alphabet down, we can start making some words. See, the specific shape of a candle tells a much richer story. It's not just about who won, but how they won. And that story is all about the epic battle between the buyers, who we call the bulls, and the sellers, the bears. And to read that story, you're really just looking for 3 simple clues: the size of the body, the length of the shadows, and the candle's overall size. It's the combination of these 3 things that tells you who was more aggressive and, how decisive their victory really was. First up, the body. Think about it. A long green body, that means the buyers were in control pretty much from start to finish. That's some strong buying pressure. A long red body shows the exact opposite. Sellers just dominated. But a short body, that suggests indecision. Neither side could really get the upper hand, and it signals a pretty weak, uncertain fight. Next up are the shadows, and man, they tell a great story. A long lower shadow means the sellers tried to push the price way down, but bam, the buyers stormed back in and rejected those lower prices. And a long upper shadow? That shows the buyers tried to push the price up, but the sellers fought back hard. The shadows literally show us where the market tried to go, but ultimately failed to stay. Okay, this is where it gets really interesting. We're going to move from words to phrases. We're going to combine these individual candlesticks into simple patterns that show up all the time. And these patterns can act as really powerful signals for a potential change in the market's direction. First up, and this one is so important, is the doji. A doji happens when the open price and the close price are almost exactly the same, so the body just shrinks down to a thin little line. What this represents is a market in perfect balance. It's a moment of pure, unfiltered indecision.
And to really get why this is so powerful, think back to physics class. Remember Newton's first law? A strong trend in the market is like a body in motion. Well, the doji is often the force that signals that momentum is fading. When you see one pop up after a long run-up or down, it's a huge warning sign that the trend might be running out of gas.
Okay, besides the doji, there are two other huge reversal patterns you need to know, and they're basically mirror images of each other, the hammer and the shooting star.
See this? This is a hammer. When you see one of these after prices have been falling, it's telling you a very specific story. The market tried to keep pushing lower, that's what that long bottom shadow is, but a huge surge of buying pressure hammered the price right back up to close near where it started. It can be a really good sign that a bottom is close.
And here's its twin, this shooting star. This one shows up after prices have been rallying. The buyers tried their best to push higher, creating that long upper shadow, but then the sellers just overwhelmed them, forcing the price all the way back down. It's a powerful signal that a top might be in.
But wait, it gets better. Candles don't just tell stories on their own, they tell them in groups. Take the morning star pattern. It's a classic three-candle story about a bottom being formed. First, you get a long red candle, where sellers are clearly in charge. Then, a small candle of indecision, maybe a doji. And it's followed by a strong green candle, where buyers just take control back. It's a whole narrative of a market turning point in just 3 candles.
Okay, so we've learned this whole new language. We know a few key phrases. But let's be real, does any of this stuff actually work? What's so cool is that we can actually look at the data to see just how often these patterns show up at critical moments.
Well, just look at this number, 88%. What in the world could that mean? It's a surprisingly high figure, right? And it points to just how reliable some of these formations can be.
So where does that 88% come from? Well, it comes from a pretty fascinating one-year study of the bond market. Researchers found that a doji, that signal of total indecision, showed up at or near the low of the day 53% of the time. And the hammer, that bullish reversal signal, it marked the low another 36% of the time. So you add them together, and one of those two key patterns we just learned marked the absolute low of the day an incredible 88% of the time. These are not just random shapes, they are statistically significant signals. And really, that's the whole point. You're no longer just looking at a bunch of random lines on a screen. You're reading the raw story of market psychology. Every single chart is a battlefield of fear and greed. Now that you can speak the language, the only question left is, what stories are the charts going to start telling you?
Okay, so if you're a trader, you know the biggest challenge, right? It's just cutting through all the noise. How do you find a clear, reliable signal when the market's throwing a million things at you at once? Well, today, we are going to dive into a strategy that does exactly that. It combines 2 classic tools into one really powerful system.
The creator of this method, John L. Person, uses this fantastic analogy: epoxy glue. And it makes perfect sense. You've got these 2 separate compounds, and on their own, they're not all that strong. But you mix them together, a chemical reaction happens, and you get this incredibly powerful bond. And that is the exact principle behind the epoxy method, taking 2 good trading tools and combining them to create one great signal.
So let's get into it, the epoxy trading method. The 2 things we're mixing together are Japanese candlesticks, specifically one really important pattern, and classic pivot points. Now, if you're not super familiar with them, pivot points are basically just math-based levels that can help you spot potential areas of support and resistance on a chart. Now, ingredient number 1 in our little epoxy mix is the doji candlestick. You've definitely seen this on a chart. It looks like a little cross. All it means is that over a certain amount of time, the buyers and sellers fought to a complete standstill. It is pure indecision, a pause in the action. And that pause, it often means a change in momentum could be right around the corner.
All right, enough theory. Let's put this thing into action. We're going to start by looking at how you can spot a potential buy signal. It's called the High Close Doji, or HCD for short, and it's a super simple, rules-based way to go long.
The rules here are just crystal clear, and that's the point. It's all about removing the guesswork. First, it's about location, location, location. You're not looking for just any old doji. You need to see one form near a pivot support level. That context is everything. Second, you've got to be patient and wait for confirmation. You don't just jump in. You need to wait for a later candle to actually close above the high point of that doji. And finally, risk management is baked right in. Your stop loss, it goes just below the low of that same doji. So you know your exact risk before you even think about hitting the buy button.
Okay,
Let's see what this looks like on a real chart of the British pound. See how the price comes down and tests that S1 pivot support line? And right there, boom, a doji forms. That's our moment of indecision. A few candles later, we get a close right above the doji's high. That's our trigger to buy. And as you can see, the market really took off from that point.
So what was the bottom line on that trade? Well, by following those simple rules, this one setup generated a profit of $620 per contract. And notice, the goal here isn't to be a hero and catch the absolute bottom. The real power of this is in capturing the big, reliable part of the move, that juicy middle section.
Now, any good strategy has to work both ways, right? We've seen how to spot a buy, so let's flip that logic on its head and see how to find a potential sell. It's the perfect mirror opposite, and it's called the low close doji, or LCD setup. And the logic is a perfect mirror image. It's super simple. For the high close doji, you're looking for that doji at a support level, and you buy when the price closes above its high. For the low close doji, you do the exact opposite. You're looking for a doji at a resistance level, and you sell when the price closes below its low. Same principle, just applied to a market that's heading down.
And here are the rules for going short. First, you spot a doji forming up near a pivot resistance level. That's a ceiling where sellers are likely to show up. Then, just like before, you wait for confirmation. The trigger is a candle closing below the low of the doji. And to protect yourself, your stop loss goes just above the high of that same doji, defining your risk right from the get-go.
Let's take a look at this euro currency chart. The market rallies up to the R1 daily resistance, and then it just stalls out and forms a doji. Again, there's our indecision. A couple of candles later, a big bearish candle closes way below the doji's low. That's the sell trigger, and you can see what happened next. The price just fell off a cliff.
The result of this short trade? By managing the position as the market dropped, it turned into a profit of over $1,000. Now, this was on a 2-lot position, which just means the trader had on twice the standard size. It really shows you how powerful this setup can be when that momentum shifts decisively in your favor.
So why does this method actually work? What is the edge it's giving you as a trader that other methods might not? Well, it really boils down to a few key advantages.
First off, this method gives you a huge advantage because you're getting in before most of the slow, lagging indicators, like moving average crossovers, even register a signal. And crucially, your risk is crystal clear on every single trade before you even get in. Better yet, this logic isn't tied to just one market. It works on Forex, futures, and stocks. But you know, maybe the most important thing is that because it's so rules-based, it helps take all that emotional guesswork out of your trading. It forces you to just focus on and react to what the price is doing right now.
You know, when you use a method like this, you make a fundamental shift in your whole approach. You stop guessing. You stop trying to predict where the market might go. Instead, you learn how to patiently wait for the market to give you a very specific, high-probability signal. You're not anticipating anymore. You are reacting.
And that really leaves us with a final thought to chew on. Maybe the real secret to successful trading isn't about having some magical crystal ball to predict the future. Maybe, just maybe, it's something way simpler, but also a lot harder to master. Just having the discipline to follow a clear, proven set of rules, trade after trade, day after day.
Hey, welcome to The Explainer. Today, we're diving into what might be the single most important tool for surviving in the markets. And here's a little secret. It's not really about finding that perfect entry. It's all about mastering the exit. So let's get into how you can really take control of your trades and, leave all that emotion at the door. Come on, you know the feeling. We've all been there, right? That knot in your stomach when a trade starts going against you, or that rush of greed when it's just soaring your way. The thing is, those feelings, they can be the absolute worst enemy of a solid trading plan. So how do we fight back? And there it is. That's the secret weapon right there on the screen. This quote just nails it. By setting your exit plan before you even click that buy button, you're not just managing risk. You're literally swapping out emotional chaos for cold, hard discipline. Okay, so what exactly is this tool? Let's break down the mechanics of what's called a stop order. Honestly, the best way to think of it is as your own personal financial safety net. Think of it like a standing instruction you give your broker. You tell them, hey, if the market hits this specific price, get me out. When that price is hit, your order automatically triggers and becomes a market order, which just means it sells at the very next price available. It's your pre-planned escape route, and it doesn't care if you're feeling scared or greedy, it just works. Now, stops basically come in two main flavors. You've got buy stops, which you place above the current price. These are perfect if you want to jump into a stock as it's breaking out, or if you need to cut your losses on a short position that's going the wrong way. And then you have sell stops. They're the opposite. They go below the current price. You'd use these to protect profits on a winning trade, or maybe to jump into a new short trade as a stock starts breaking down. So why is this all so ridiculously important? Well, first off, using stops should be a non-negotiable part of any real trading system, period. They force you to define your maximum pain point, your risk, before you ever put a single dollar on the line. But here's where it gets really strategic. Stops aren't just set it and forget it. When the market is quiet and calm, you can keep them nice and tight. But when things get choppy and chaotic, a wider stop gives your trade the room it needs to breathe without getting shaken out prematurely. So that brings us to the stop placing playbook. Look, knowing you need a stop, that's the easy part. The really hard part is figuring out where the heck to put it. Let's dig into some of the most common methods and strategies. All right, so the simplest methods are based on fixed rules. You could go with a dollar limit, where you just decide, I'm not going to risk more than, say, $250 on this trade. It's simple for sure, but it completely ignores what the market is actually doing. A much more common approach is using percentage figures, risking a small fraction, maybe 2%, of your entire account. That's a classic money management technique. But honestly, the pros often let the market itself tell them where to put their stops. A time factor stop is interesting. If a trade just isn't working out after a certain amount of time, you just get out. Price level stops are way more common, though. You might place them just outside a key support or resistance zone. And here's a pretty cool advanced technique: conditional changes. This means your stop only gets triggered if the price closes below your level at the end of the day. This can help you avoid getting knocked out by one of those crazy, meaningless price spikes that happen midday. Now, this all brings us to a really, really critical point. Knowing all these methods is one thing, but there is a huge trap that so many traders fall right into. So, where do you think they usually place their stops? Yep, right at the most obvious spots. And this chart illustrates the danger perfectly. Just look at these spike tops and spike lows. The market has this nasty little habit of pushing just a tiny bit beyond an obvious old high or low, which is exactly where everyone's stops are all clustered together, just to trigger them all, and then poof! It reverses direction, leaving everyone behind. This is what people call stop hunking. So the big takeaway here is this: you've got to think like a predator. Your main job isn't just to set a stop, it's to place it out of harm's way, away from those super obvious levels where the market is probably going to go hunting for orders. Your stop needs to be a shield, not a target.
So how do we stay ahead of the game? Well, this leads us to a much more dynamic, much more powerful tool. It's great for protecting your capital and for locking in your profits. Let's talk about the trailing stop.
The whole concept is actually pretty simple, but it is incredibly effective. You start with a normal protective stop, just like we've been talking about. But as the price moves in your favor, you move your stop up along with it. The number one rule: it never, ever moves back down. What this does is it lets your winners run, while you systematically lock in profits piece by piece along the way. Let's just look at this chart of a short trade to see it in action. Okay, so the initial stop was placed above the entry point. Now, as the price falls, notice how the stop is methodically trailed down. See that? It's always staying just above the most recent little peaks in the price. This gives the downtrend plenty of room to work its magic, while protecting all that open profit from a sudden reversal. And the outcome of this strategy? It's just so powerful. By using a trailing stop, you completely abandon the impossible goal of trying to sell at the exact top or buy at the exact bottom. Nobody can do that consistently. Instead, you aim to capture what the source material calls a solid chunk of the middle of the move, and you get to do it with way less risk and a whole lot less emotional pressure. All right, let's bring this all together. When you boil it all down, what's the one thing that really matters? It all comes back to a single word: discipline. I absolutely love this quote from the source. It just flips a common misconception right on its head. You know, some people think using a stop is a sign of fear or weakness. No way. It's the mark of a professional, someone who respects the market and protects their capital. It's a tool of strength, not weakness. At the end of the day, there is no single magic formula here. There's no one best method. It doesn't matter if you use a percentage rule or a volatility measure or a trailing stop. The goal is always the same. Your mission is to find a consistent, repeatable method that lets you cut your losses without even thinking about it and gives your winning trades the room they need to grow into something really great. So I'll just leave you with this one question to think about before you place your next trade. Based on everything we've just talked about, what is the one concrete rule you're going to commit to right now to protect your capital and trade with discipline? All right, let's talk about what is, for my money, the single hardest decision in all of trading: knowing when to sell. I mean, finding a good entry point is one thing, but figuring out the right moment to take your profits, that is the real art. And it's what separates the pros from everyone else. So let's get into it. So just imagine this for a second. You've done your homework, you've placed your trade, and bam, the market moves in your favor. You're profitable. It's a great feeling, right? But now the real work begins. The million-dollar question is staring you right in the face. What do you do now? And look, if you find that question stressful, you are not alone. It's pretty much universally agreed that actually exiting a position, taking that money off the table, is the absolute toughest part of this game. It's that critical moment where raw emotion, fear and greed, can completely hijack what was otherwise a perfect trade. So how do the best traders on the planet handle this kind of pressure? Well, it all starts with their mindset. They make a critical shift from just wanting to win to actively preparing to win. Let's break down what that really means. I love this quote from the legendary basketball coach Bob Knight because it is so perfect for trading. See, the will to win, that's just an emotion. It's hope. But the will to prepare to win, that's about having a process. Think about it. Championship teams don't just walk onto the court hoping for the best. No way. They have a playbook, they've drilled for every possible scenario, and when the time comes, they just execute. And that preparation, that playbook, it basically becomes your shield. It's what protects you from the two emotions that will absolutely destroy a winning trade: the fear of losing what you've gained and the greed of wanting just a little bit more. A solid plan takes emotion right out of the driver's seat. Which brings us to the specific play we're going to break down today. It's called scaling out, and it is a powerful, systematic plan for taking profits that does all that emotional heavy lifting for you. So what in the world is scaling out? Well, it's actually a really simple but brilliant idea. Instead of having just one exit, an all-or-nothing moment, you sell your position in pieces. This lets you lock in some guaranteed profit while still giving the rest of your trade a chance to mature and, hopefully, run even further. Now, a super common, really simple rule of thumb that a lot of traders use for this is the 50% rule. It's exactly what it sounds like. The moment your trade shows the very first sign that its momentum is starting to fade, you sell half of your position. Simple as that. Let's just lay this out in 4 easy steps. Number 1, you enter your trade based on your signals. 2, you keep a close eye out for those specific signs that the trend is slowing down. 3, the second you see that signal, you sell half. And then 4, you manage the rest of the trade by trailing your stop. And all that means is you're moving your safety net, your stop loss order, up behind the price to protect the profits you've already made. Okay, theory is great and all, but let's see how this actually works in the real world. We're going to jump into a couple of charts to really deconstruct how scaling out plays out moment by moment. All right, here we go. Example 1. Now you can see the price has been in a pretty clear downtrend, right? But then, look right down here at the bottom. We get this hammer candlestick. See that long tail sticking out the bottom? That's our tell. It means buyers are suddenly stepping in with a lot of force, pushing the price all the way back up. For us, that's the signal to buy. So the trade moves in our direction, everything's going great, we're in the money, but then, way up here, we see this little guy, a doji candlestick. That tiny little body with wicks on both sides, it's a classic sign of indecision. The bulls and the bears are in a tug of war, and nobody's winning. It's a huge clue that that strong upward momentum is losing steam. And that's our cue. That's the signal to act. We immediately sell half of our position. Boom! We just put real, actual money into our account. That's a realized gain. Then we just trail our stop loss up on the half we still own. And in this case, wow, after a little pause, the market just explodes higher on this huge run. And because we scaled out, we're still in the game to capture that massive secondary move. Okay, so let's flip the script and look at a short trade. In this example, a low close doji gives us our signal that the market is probably heading south. So we enter a sell position, and just as we predicted, the market starts to drop nicely in our favor.
So we're riding this downtrend, feeling pretty good, but then the market just kind of hits a wall. You see how the price stops making new lows? It just starts bouncing back and forth in this little channel. That's called consolidation, and it is a crystal clear signal that the powerful downward momentum has stalled out, at least for the time being. So what's the play? You got it. We cover half of our short position, locking in that profit. Then, and this is a really slick move, we move our stop loss down to our original entry price. Now think about that. The rest of this trade is now completely risk-free. We literally cannot lose a single penny from this point forward. It's a beautiful thing.
So as you're starting to see, this is about so much more than just the mechanics of making a trade. It's about trading with confidence, with a real sense of calm. You're securing your hard-earned profits, you're staying in the game for those potentially bigger wins, and you can actually sleep at night knowing you have a plan you can trust. This quote just perfectly captures the whole spirit of this strategy. You know, attempting to do nothing and succeeding, that's like cashing out a trade way too early just because you're scared. But scaling out, that's the plan to attempt to do something great. It's a method to systematically capture both a safe, guaranteed profit and potentially ride a massive trend to the very end. So let's just recap the huge benefits here, okay? You are capturing real profits while they're on the table. You are dramatically reducing the emotional roller coaster of trading. You get to stay in the trade for those potential home run gains. And most importantly, you're not just gambling. You're following a clear, repeatable business plan.
You know, when you really boil it down, scaling out is all about finding that perfect balance between fear and greed. You're systematically taking the money the market is giving you while leaving the door wide open for that trend to turn into something truly special. It's all about discipline over emotion, every single time. So we've just walked through a detailed, professional plan for how you get out of a trade. And that really just leaves one final and maybe even more important question. Is your plan for getting into a trade just as disciplined and well thought out? Because at the end of the day, in this game, every single decision matters. Thanks for tuning in. You ever feel like your trading is just guesswork? Well, if you have, then you really need to hear this. We're about to dive into the one concept that can turn trading from a total gamble into a data-driven business. And that's all about building and, more importantly, proving a trading system. Oh, we've all been there, right? A trade starts to go against you, that knot of fear tightens in your stomach, and you bail out way too early. Or the other way around. You're on a hot streak, you feel invincible, greed whispers in your ear, and suddenly you're risking way too much. It's these emotional roller coasters that completely derail most traders. But what if you could just take all that emotion out of the equation? Well, the solution is to make a shift, a big one. You stop trading based on feelings or hunches, and you start trading based on a predefined, totally objective set of rules. This right here is the absolute core of what it means to be a systems trader. And look, this isn't just some nice-sounding idea. History has shown this to be a fundamental truth in the markets. The traders who actually survive and thrive for the long haul, they're the ones who operate with discipline, following a plan they already laid out before the market even opened. So what is a trading system exactly? The best way to think about it is as your personal, non-negotiable rulebook for the market. It tells you precisely when to buy, precisely when to sell, and exactly how to manage every single trade, all based on cold, hard data. It's designed to replace gut instinct with a clear, mechanical process. Feelings? Not invited to this party. But, you know, just creating a set of rules is really only half the battle. How in the world do you know if your brilliant idea is actually any good before you start risking real money? Well, that's where the real magic happens. This is the million-dollar question, isn't it? I mean, you might notice a pattern or have a theory about how some indicator works, but a theory isn't a strategy. We need proof. We need to put that idea on trial and see if it holds up. And that trial, it's called backtesting. The process is pretty simple in concept. First, you take your idea and you forge it into a set of specific, unbendable rules. Then you unleash those rules on years and years of historical market data. You analyze every single outcome, the good, the bad, and the ugly, and you use that hard evidence to refine your strategy. Okay, let's make this real. Enough with the theory. We're actually going to walk through the real-world backtesting results of an actual trading system to see what this process looks like in action. So we'll be looking at a system called the DEFCON model. It's based on pivot point analysis. The test we're looking at covers a 3-year period,
from 2003 all the way to 2006, and it's trading one of the most popular instruments on the planet, the S&P 500 E-mini futures. Okay, here it is, the full performance report. I know. This looks like a spreadsheet declared war on a calculator, and it is so tempting to just glance at that total net profit number and call it a day. But listen, that single number tells you almost nothing. The real story, the info that will make or break you as a trader, is buried deep in the details. So we're going to break down the most important ones right now. All right, let's pull this report apart. We're going to look way past the final profit number and uncover this system's true personality, its strengths, its weaknesses, and maybe most importantly, its tolerance for pain. The first number that always jumps out at people is the winning percentage. Here, it's 63.6%. Now, that sounds pretty good, right? Winning almost 2 out of every 3 trades. But this number by itself can be incredibly misleading. A system can win 90% of the time and still lose a ton of money if those few losses are just absolutely catastrophic. And that brings us to a much more important metric. How much do you make when you win versus how much do you lose when you're wrong? Looking at our data, the average winning trade made $469, while the average losing trade costs $398. That's a positive payout ratio. It means our winners are bigger than our losers, which is just absolutely essential if you want to be profitable in the long run. And now, for what might just be the single most important number on that entire report, the maximum drawdown. This tells you the largest peak-to-valley drop the system's equity ever experienced during the whole test period. In this case, at its absolute worst point, the system gave back over $4,000 in profits. Now, what's so powerful about this is that it shows you what that drawdown actually feels like. This is the system's profit journey over time. See that big dip? That's the max drawdown happening. Knowing in advance that your system is capable of this kind of drop is what gives you the emotional strength to stick with it when it happens in real time, instead of just panicking and blowing up your whole plan. But here's the real secret. Backtesting isn't just about confirming that your system makes money. No, its true power is showing you when and where your system fails. This is the mindset shift that separates the pros from the amateurs. You're not just looking for a pat on the back. You're a detective. You are hunting for the fatal flaw, the chink in the armor. Why? Because identifying a weakness is the very first step to either fixing it or avoiding it completely. And this chart proves that point perfectly. When we break down the system's performance by month, a glaring weakness just pops right out. Look at April. Over a 3-year period, it consistently lost money. Now, this isn't just some curiosity. It's a powerful, actionable insight. It gives you a choice. You could trade with smaller size in April, you could add a new filter to avoid those bad trades, or maybe you just turn the system off for the whole month. A truly robust system should also be tested on different markets. And look what happens when we apply the exact same rules to the euro currency. The personality is completely different. The profit was much higher. But look at the trade-off, the risk. That max drawdown more than tripled to over $13,000. This proves the system is a totally different beast in a different environment. And you have to know if you can stomach that higher risk for the higher potential reward. So when you put all of this together, what is the actual edge that this whole process gives you? It's not about finding some holy grail that never loses. It's about something much more profound. Backtesting gives you the statistical evidence you need to actually trust your signals instead of second-guessing them. It gives you the emotional grounding to ride out the losing streaks that are absolutely going to happen. It tells you your system's pain threshold, that maximum drawdown number. It gives you incredible insight into when you probably shouldn't trade. And most crucially, it provides a data-driven foundation for a real money management plan. Ultimately, this is the big takeaway. The edge isn't some secret indicator. It's using objective data to prepare yourself for the realities of the market. And that gives you a massive advantage, not just strategically from a business stance, but just as importantly, emotionally. Whether it's your own system or one you're just looking at, the historical data is telling you a very detailed story about its character. The only question left is, are you taking the time to listen?
Hey there, and welcome to The Explainer. Today, we're digging into a fundamental truth about trading. You know, the toughest market you'll ever face isn't the S&P 500 or Forex. It's actually the 6 inches between your own ears. Yep, mastering your own psychology, that's the real key to consistent performance. So let's dive right in.
All right, here's our game plan. We're going to break this down into 4 parts. First, we'll get real about why you might be your own worst enemy. Then, we'll nail down the single most important rule of all: wait for the signal. After that, we'll get practical and talk about building discipline. And finally, we'll cover how you can practice to build genuine confidence.
Okay, first up, your own worst enemy. And right off the bat, we need to completely reframe how you think about trading. See, the main fight isn't you against the market, no way. It's you against your own gut reactions and your own emotional impulses.
So, let me ask you a question right up front. What do you think a trader's biggest enemy really is? Is it a crazy volatile market? A bad strategy? Maybe some unexpected news that tanks your position? What is it?
Well, according to veteran trader John Person, the answer is way more personal. He puts it pretty bluntly: lack of confidence and fear are your enemies. Think about that. It's not some outside force that gets you, it's what's going on inside your own head. And these are those internal enemies we're talking about. You've got the fear of missing out, FOMO, that just screams at you to chase a price that's already taken off. Then there's greed, which whispers in your ear, just jump the gun, get in early. And of course, there's plain old impatience, because, let's be honest, waiting is hard. All of these feelings, they lead to the same huge mistake. You end up trying to outguess the market instead of just reacting to what it's actually doing.
So, if our emotions are the enemy, what's our weapon? Well, that's the perfect lead into our second section, which is really the heart of this whole thing. It all comes down to one golden rule of discipline. You have to wait for the signal.
In this image, wow, it just perfectly shows you why. You see a candle forming, it looks like this massive bullish breakout is happening right now. Your heart starts pounding, that FOMO kicks in, and you just want to dive in head first. But if you don't wait for that candle to officially close, you could find that the price completely reverses, just like you see on the right. And boom, you've just bought the high of the day. Patience is literally your shield here.
So here's the absolute critical takeaway, the centerpiece of any disciplined strategy. You never, ever take action because you think a signal is about to happen. A trigger is a call to action based on a rule that has already been met, not one you're predicting is coming. It's a reaction, not a prediction.
Okay, let's look at a real-world chart to see this in action. We're looking at a stochastic indicator here. Now, look on the left. You see the lines cross? That could be a buy signal. An impatient trader jumps in right there. But look what happens. The price doesn't actually go higher. It's a classic trap. Now, look over to the right. Here, the lines cross and the price makes a higher close. That is your confirmed signal. That's the trade with the odds in your favor.
You can really see the two mindsets side by side here, and man, the difference is night and day. Anticipating a trade is all about emotion. It's high risk, it's jumping the gun, and it usually ends in losses, which just traps you in that cycle of fear and greed. But waiting for a signal, that's disciplined, that's patient, it's based on rules, not feelings, and it puts the odds back on your side. And most importantly, that's how you build real, lasting confidence.
All right, so we get the what and the why. Now it's time for the how. How do you actually build this kind of bulletproof discipline when you're in the heat of the moment? Well, here's your practical toolkit.
Look, discipline doesn't start when the market opens. It starts with your state of mind before you even sit down. You should absolutely not be trading during major life events, if you're moving, going through a divorce, anything like that. Don't trade if you're angry or distracted. Your emotional edge is every bit as important as your technical one. You have to be in a mental space where you can calmly accept that small losses are just part of the cost of doing business.
So here are 3 simple, powerful things you can do to enforce that discipline. Number 1, write down your rules. I mean, literally, put them on a sticky note and stick it on your monitor. Second, keep a trading diary. You got to track every single trade to hold yourself accountable. And third, and this is a fantastic one, print out your charts and analyze them. Make your performance something you can physically hold and review. And here's a perfect example of what that third step actually looks like. You see the chart here? The entry is marked, the target is clear, the exit is shown. You are literally grading your own homework. Did you follow your plan? Yes or no? There's no hiding. There are no fuzzy memories when the data is right there in black and white. This is how you build good habits. All right, this leads us to our last and maybe most important section.
practice for real confidence. This is all about closing that massive gap between knowing your system on paper and actually being able to execute it when your own hard-earned money is on the line.
Okay, first things first, we have to talk about a concept called scared money. It's this weird paradox. It's money that you're so terrified of losing that your fear-based decisions, like, cutting a winning trade way too early, actually cause you to lose it. This is the core reason why trading with real money feels so different than just playing on a simulator.
And this breakdown really shows the huge difference between the two. Simulated trading, it's great for learning how to use the software, but that's about it. There are no emotional stakes, so it doesn't test you on fear or greed at all. But real trading, even with tiny, mini positions, that tests your system and your emotions. It puts real but manageable money at risk, and that's how you build genuine confidence. You're actually exercising your emotional discipline under pressure.
So how do you actually practice this stuff without blowing up your account? Here's the game plan. For about 6 to 8 weeks, just trade with the smallest position size you can. If you normally trade 200 shares, dial it back to 50. Or maybe check out an ultra mini Forex account where the stakes are super low. Remember, the goal here isn't to get rich. The goal is to train your brain to act on your signals calmly and without hesitation when there's real but manageable pressure.
So let's bring it all home with these 4 simple, powerful rules to live by. Number 1, look for buy signals near support. 2, look for sell signals near resistance. 3, when your system gives you a signal, you act on it. No hesitation. And 4, when your system says it's time to get out, you get out. That's it. Period.
And that leads us to the final critical question. The rules are simple, the concepts are clear, you have the knowledge now. So really it all comes down to this one question you have to ask yourself. Do you have the discipline? Because in the end, that is the one thing that truly separates a winning trader from everybody else. Thanks for joining us.